Welcome back. In this video, I show you how to trade fake breakouts or fakeouts the right way. And we're going to apply a top-down approach, and I'll show you exactly how to get into a trade, what are the best entries, where to put the stops, how to achieve the best win rate, and everything else that you need to know in order to trade fakeouts successfully. In order to learn fakeouts and trading fakeouts the proper way, I'm going to show you a few different variations of how different types of fakeouts look like. So let's start here, and we can see that the market has been moving back into a previous support area. And this is a very important piece of information because previously what has happened here is the market was in a downtrend, and the downtrend turned higher. And the market is back now. So a lot of traders are probably going to look for continuation trades. However, when we look at the broader picture, we can see that the market has been trading lower for a long time, for actually many months. So looking for a short continuation is already a lower probability trade because we are very late in a trend. Could still happen, but I would approach shorts with more caution. So if I would be a short trader, I would look for a breakout continuation. So I don't want to only look for a breakout, but I want to see that previous support is turning into resistance. If that doesn't happen, I wouldn't be short. So I would, in this case, just start following the price action and see what are we going to do. Is the market going to do the break and retest, or are we going to pull back? In this case, we could start looking for fake out trading opportunities. So let's just see. And you can see that the market is, for now, giving us this indecision candle. So we had a pretty strong move to the upside, and then the market was rejected and the price closed somewhere in the middle of the previous red candle. So wait one more candle and see what are we going to do. Is this a retest candle where we are testing previous support now as resistance, or what is actually going on? We don't have enough information yet. Here we actually now do have enough information because we can see that the market pulled back violently into the highs. So the market tried to break below the low. A lot of people were probably trading the breakout and then got trapped here. So we have a trap pattern here, which is a fake out as well. And in this case, I would now start going to a lower time frame to look for trading opportunities into the direction of the fake out. So we are going to look for long opportunities on a lower time frame. So we are on the 4 hour, and we could, for example, start looking at the 30-minute or the 15-minute now. This is how it looks on the 15-minute time frame, and this is how the big candle on the lower time frame looks like. You can see I have added the 50-period SMA that will help us with our entry timing. And what we are seeing now is that the market has broken above the moving average, and it's making its first trend wave above the moving average. So we want to wait for the first consolidation. We want to see that the market is moving back into the moving average and then away. Very often you will find a pattern that looks something like that. This is exactly what we want to wait for. So we want to see that this pattern is shaping up. It is moving into the moving average, which is this area, and that is what we're going to use for our entry timing. Very often you will be able to see flags, channels, triangles, or other very important consolidation patterns that we can then use to time our entries right at the perfect confluence. And those are really high probability trading scenarios. So let's get rid of this and see what happened afterwards. We follow the price action a little bit going forward. You can see the market is moving higher, lower, moving sideways. So this looks like this could be our first move back into the moving average. So we're following the price action. At this point, we can start drawing here a trend line. So we are starting to see a flag pattern. And when you see something like that, this would get really interesting because we are almost at the moving average. And if you see a breakout out of the channel, this could trigger our trade. And you can see that this happened afterwards. So we can see that the market is breaking out of the flag. We moved reasonably close to the moving average, so you don't necessarily have to see that the market is touching the level or breaking through it. We want to see just the context makes sense in the overall picture. So we have the flag, we have the first move back into the moving average after the breakout, and that is what we want to see. So in this example, we could decide to go long here. Stop loss would recommend to either move it below the moving average if you want to have a tight stop loss approach, or if you prefer a little bit of a wider, you could move it underneath the channel. So that is a little bit up to you, but in this case, we could think about moving it at the moving average and then see what has happened. A target idea could be either you go for a 2-to-1, 3-to-1 fixed, or we just trade it along the moving average. So let's just follow the price action, and you can see the market is unfolding nicely, moving higher and lower. In this example, let's assume we're just pulling it beyond or along the moving average rather. And when is the market breaking the moving average for the first time? So we're still in the trade idea, and you can see it has kept going and going and going until still, okay, here we are now out of the trade, and you can see that the market is moving lower. So let's see what this gives us. And if we extend it forward and just check our reward to risk ratio, this would have been, we don't catch the absolute top with a trailing stop loss approach, but you can see still reasonably good outcome. And this is a 6.8 reward to risk ratio. So even if you trade with a very low win rate, around 20%, 30%, you're going to end up making money with a 6.8 reward to risk ratio, just based on pure statistics. So a very interesting approach, how you go from a higher time frame fake out to lower time frame entry timing with a retest approach. So you can very nicely see how we go top down to find the perfect trading entry. Let's look at a different type of fake out, and you can see that the market moved higher very, very strongly and pulling back, and a lot of traders are probably now looking for continuations. So probably a lot of traders are waiting for the market to break higher. Probably a lot of impatient traders are already along here because the market just briefly dipped here above it. So let's see what actually happens. However, if you want to be a successful breakout trader or continuation trader, you always want to wait for the market to actually get above a level and then come back into it. So if you want to trade long, definitely have to wait for that. Otherwise, you're going to run into a lot of fake outs. And we are going to look for how's the market reacting. And if we get a fake out, we're going to look for shorting opportunities now. So let's see what actually happens. And just quick reminder, this is something that is often very unsustainable. So probably this huge move within just 2 or 3 candles is probably news driven, or very likely news driven. And those moves often fade and they're often reversed. So if you see something like that on a news spike, especially if it's not in line with the news data that is released, sometimes you see that the news number come out and the market does something that doesn't really make sense. Very often you will be able to use that as a fake out approach. So in this case, let's go down to a lower time frame. And in this case, on the 30-minute time frame, first of all, we see that we are on the wrong side of the SMA. So as long as the market is above it, we don't want to be short. So let's see what happens afterwards. And ideally, what we want to see is a move lower, a move back, and then a continuation. And ideally, this retest pattern happens around or at the moving average. We're going to look again for some type of pattern, channels, wedges, triangles, anything that would help us allow time and entry. So right now, we are a little bit too early. We want to be short. We know that from the higher time frame, but we don't know when yet. So let's see. And we're following the price action. Now you can see the breakout has happened, but we don't want to be a breakout trader. We want to be a pullback trader and go with a different type of entry on the lower time frames. We want to wait for the first breakout wave to be over. And let's see what we have. The market is coming close and retesting the moving average. All right, so what we're going to do now, we can see we have a few options. We have here probably some type of flag pattern waiting for us, or maybe actually a triangle. So we have something like that. So in this case, what we're going to do is wait for the market to break out of this pattern and then look for an entry. So let's see. It's looking good. We have some reaction. Not quite yet. Not quite. Still in the triangle. Don't be impatient. We are retesting the highs. And now we have our entry. So we want to be short. We know that this is our retest entry. Stops, you can put it safely behind this area now. We don't have too many options. It's not necessarily to put it at the high of the pattern on the higher time frame. In this case, it should be okay at least to put a stop loss here. If the market goes above this point, I definitely don't want to be short anymore. So that makes a lot of sense. And then we could think about an open-ended target, trade it along the moving average. Or if you want to have a fixed target, maybe a 3-to-1, maybe a 2-to-1, scale out at 2-to-1 and then let it ride. A few options that you have. So let's see what the market is doing. It's moving higher against us, but it's okay. We have a stop in place. where it makes sense. So let's speed it up. You can see the market is, progressing and moving forward. Okay, and you can see it looks good for us. Now you can see we're challenging the moving average, but it's being rejected, which is good. We got away with a black eye. So you can see we're moving lower. The 2-to-1 reward to risk ratio would have been hit already. You can see if we go for 2-to-1, you would have been out quite a while ago. And if you're going for a higher reward to risk ratio, obviously your win rate will drop because there's a lower likelihood that the market actually will make it that far. But you can see the market is moving along, and it would have hit your 3-to-1. And shortly after also it would have had a break above the moving average. So in this case, a trailing stop loss approach along the moving average would have given you less than 3-to-1. But that is always the case. If you use a moving average for a trailing stop loss, you're never going to pick the absolute bottom or the high in an uptrending market. But that's just the nature of a moving average. So you have options. You could have exited maybe your first position at 2-to-1, maybe at 3-to-1, move a stop loss along the moving average as well, and then approach it in those ways. Let's look at a very common type of fake out as well. And now we're going to look more at a local structure. So you can see the market is clearly in a downtrend. We are making lower lows and lower highs, and the market is reaching a previous low. So a lot of traders are going to jump short here because they have missed the initial move, or probably they have also missed what has happened previously, and now they don't want to miss what is coming. But we don't know yet. The market is struggling here. It is not making it slow yet. So if you are short, you're way too early and you are not trading into a new lower low. The market is still hasn't made a lower low yet. And the next candle, this is exactly what you will often see. The market just barely pinched lower and then shot up higher. So now you're looking at a fake out. A lot of impatient traders are already short, and either the stop loss has already been hit or they're sitting at a big drawdown now and they are probably sweating a lot. And this is very common, so we don't want to be one of those traders. Instead, what we are going to do now is go to a lower time frame. We're going to jump to the 15-minute, and let's see what we have. We're going to turn on again our 50 period. And what do we have? We have already here our breakout out of this structure, but obviously we don't want to go long now because the market has already moved higher. We want to wait for the market to pull back into the moving average, give us a structure, and then look for a continuation. So what is happening? The market is moving lower, but still not too close to the moving average. Okay, now we get slowly some type of nice price action. Let's zoom in and see we have a double top, which we could use here for a breakout. So if the market breaks out of this structure, we could start looking for a long. So that is a great continuation pattern actually. Let's see, we're getting close to the moving average as well, which is good. The moving average is coming higher. We are at a previous high. And again, we don't want to be long below a resistance level. We want to wait until this happened. So we want to be long now. And our stop loss could be just below the breakout level, or in this case, we could also use the moving average, which is offering here itself. So again, for targets, let's again, just for the sake of this example, make a fixed 2-to-1, maybe 2.5-to-1 reward to risk ratio, and then see what the market is doing. So let's see after this entry, what would have happened. You can see we have a continuation at first. Looks good. The market is struggling, coming back. So let's see, is the market coming back? We want to see definitely that previous resistance is holding. I wouldn't be very happy if the market now breaks my resistance level, but if we get a retest, we could even think about adding to our position. So see what happens. It's coming very close, and you can see we have now a confirmation retest. So you can see the market moved into the moving average a few times, looked for support and found support, and is shooting higher. So if the market breaks above this area, we could think about a potential re-entry. So we could add to our position. So let's assume we want to actually do that. We go long here a second time. Our stop loss, again, below the moving average. And by this, we could have already pulled our first stop loss to the moving average as well. So we have taken away a lot of risk for the first position because our stop loss is almost at the entry, and for the second position we are now just in it. And again, we could, for example, go for a 2-to-1. We could also use the moving average, a little bit up to you based on your personal preferences. So let's see what is happening. It looks good. It doesn't look too convincing, but we have our stop loss and we are not going to pull it too close. You can see it is still tucked away behind the moving average, and you can see, so what happens is that you're going to move your stop loss along the moving average, but never right at the moving average. That's one of the main and key principles of a trading stop loss approach. You never put it right at the moving average because retests are just so common. And also you're going to deal with spread and volatility. So a stop loss is never put right at a moving average because that is just a very, very common thing to see. Can see by this point your stop loss is probably going to be somewhere very close to your entry, so we almost made it to a break-even trade, which would have happened here. So by this point we are a little bit better than break-even for the second position, so we would just write it out. You can see as the trend progresses we are able to trail our stop loss, and now we would be out. So you can see the first position would have made a very nice reward to risk ratio from our entry to our exit, and the second position, not a huge move, but still quite a decent outcome. And we're looking at a high probability multi-time frame approach. Remember, we started with a 4-hour time frame. We were looking at a previous low, the breakout failed, the market moved higher, and then on the lower time frame we really sniped our entry very nicely.